Hello, my name is Yu Zhong. I'm a portfolio manager on the Asian equities team here at Aberdeen, and today I'll be providing a brief Asia outlook. There are four themes I would like to discuss as we head into year end. First, is the US growth story running out of steam? Second, the China recovery potential. Third, inflation across Asia. And fourth, the capex comeback. Against a volatile backdrop, the US market, both stock market and the economy, have held up well so far this year and shrugged off recessionary concerns. However, we can see here on the left-hand chart that household savings, which have been helping to extend the current cycle, are rapidly depleting as a percentage of GDP. On the right, the graph shows there is still a significant amount of corporate bonds in the US coming up for refinancing next year. These will be at a higher rate, which will restrain corporate America's ability to invest in growth. In the past, low-cost debt could be used to fund share buybacks, which has helped to boost earnings per share for investors. We suspect that US growth will struggle to keep pace with what we've seen so far this year and expect a recessionary scenario in the next year or so. Meanwhile, we see potential for a China recovery building into 2024. China's core inflation has remained low. The divergence to US inflation can be seen on the left-hand chart. Lower inflation means greater spending power, which creates a conducive environment for growth. Chinese consumers have also been building up their rainy day buffers during COVID. The right-hand chart shows the extent to which household deposits have increased relative to a fall in household loans over the past 2 years. We believe this sets the scene for a consumption-driven recovery. Whilst inflation remains a global concern, the inflation picture is still relatively more benign in Asia. Inflation remains below central bank targets across most Asian countries, and on the right, we can see that inflation peaked across Asia already in the last 2 years and have been falling during 2023. As mentioned earlier, lower inflation means greater spending power, which helps set the foundation for growth. Against this backdrop, we're seeing investments coming back to Asia. On the left, the blue line shows that global capex, having fallen for the past decade, is now showing positive growth. This comes despite a continued decline in relative performance between the MSCI Asia Pacific ex-Japan and the MSCI World, shown in the black line. And this trend could break should we see a sustained increase in global capex. On the right, we can see that Asia is a key beneficiary in growing global capex. Asia stands to take the lion's share of renewable energy investments. The top chart shows that over the last 2 years, more than half of global investment in green energy has been in Asia. The bottom chart helps to highlight Asia's case as a key hub for future technologies. Taiwanese semiconductor foundry company TSMC is expected to deliver double-digit profit growth over the coming years and is one of the main beneficiaries of growing investments in advanced technologies such as generative AI, machine learning, and autonomous driving that requires a growing number of increasingly complex semiconductor chips. Finally, we will look at how Asian markets are priced. The left-hand chart shows that Asia continues to look cheap relative to the rest of the world on a forward earnings basis. On the right, the main Asia Large Cap Index is trading at a discount relative to history as well as relative to developed markets, despite offering double-digit returns on equity. Asia remains home to some of the best companies in the world, under-owned, undervalued, and underappreciated, but at an inflection point from a macro and micro perspective. Thank you very much for your time today.